So again, my name is Adit Singh. I'm Managing Director with Silicon Valley Bank. Silicon Valley Bank has been dedicated to entrepreneurship, technology, and innovation for more than 30 years now. And we're very proud of our long-term association and partnership with TiE and TiEcon. So I'm here to moderate this next investor panel. I think the panel prior to ours is a terrific segue. In this discussion, we'll be talking about venture capital. And why don't we get started by asking each of the panelists to introduce themselves and their firms. We have a terrific panel with some of the venerable names in the industry, and I'm looking forward to their insights. So, Rohini, why don't you get us started?
My name is Rohini Chakravarthy. I'm a partner at NEA. We are a venture capital firm based here in Menlo Park and in Washington, D.C. We have 2 offices in India and 2 offices in China. The firm was started in 1978 and is a broad-based firm. So we invest in early-stage companies as well as growth-stage companies across technology and medical services. I'm a partner here in Menlo Park. I focus on enterprise infrastructure, so a lot of my investments are in some of the themes that we'll probably cover today. Just kind of a plug for TiE. I've been the lead for the TiE Women CEOs and Founders Forum for the last 3 years, and it's been a wonderful group. So if there are some of you who are looking to be part of that, I'd be happy to talk to you offline. Also, NEA has been a sponsor for 20 years, and we're happy to be here.
Good afternoon, everyone. My name is Aaref Hilaly. I'm a partner at Sequoia Capital. Sequoia, we've been in business for about 40 years. We got going when our founder, Don Valentine, visited Steve Jobs in his parents' garage, and our investments in Apple were followed by investments in Oracle, Cisco, Yahoo, Google, LinkedIn, more recently PayPal, Square, Airbnb, and many others. So I've been at Sequoia for a couple of years. I first came to Silicon Valley 15 years ago with the ambition of starting a company, and shortly afterwards started a data center automation company called Centron. Then after that, an analytics company called Clearwell, and built those companies and sold them for about a combined $500 million. Both companies were funded by Sequoia, who was a tremendously supportive partner to me as an entrepreneur. And I now work with a range of early stage companies representing Sequoia to help other entrepreneurs in the same way.
Good afternoon, Igor Taber from Intel Capital. Intel Capital is an investment firm that invests on behalf of Intel. I've been investing for around 20 years globally. I think we're physically present in 25 countries, invested in around 50 countries around the world, on average $400 million a year in terms of capital, across stages and across technology areas. Primarily 2 objectives for each investment. One is a financial one, similarly to other folks here. And second objective is how we can leverage Intel resources to help the portfolio companies to go faster, acquire more customers, et cetera. I'm personally, within Intel Capital, responsible for our big data, analytics, and cloud infrastructure investments.
Hello, everyone. My name is Adit Singh, and I'm a partner at Foundation Capital, focused on enterprise infrastructure broadly. Foundation Capital has been around for about 20 years. Majority of our investments are in broadly the IT category. 30% are in consumer and about 10% in financial services. At the highest levels, I've been in 3 different startups before I became a venture capitalist. One got bought by Cisco. I was trained as a chip designer there. One went public and one failed, and I learned the most from the one that failed.
Great. So yesterday, the tracks here at TiEcon were around big data, cloud, and Internet of Things. So, certainly a lot of buzz in these sectors. Can you guys tell us where your firms are investing, where you're personally investing, and what are the biggest opportunities for disruption right now? You want to take that?
Sure. I can start us off. Yeah, so the enterprise infrastructure space is one of our, I guess, bread and butter spaces. We've been a broad sector investor in big data and the cloud transformation for a number of years now. Last year we had Tableau go public, and that was actually an investment that we had originally made in 2004. So we sort of started the whole theme around big data pretty early on. On the cloud space, we've also been investing pretty broadly in all parts of the stack. So starting with applications, we're an investor going back to WebEx and Salesforce, which were original, I guess, SaaS applications. And last year we had Workday that went public. So we've been in the application space very strong, as well as in the infrastructure areas, which is most of the space where I do my work. So in the new database areas, we're an investor in Mongo, and I'm on the board of Aerospike. So very broad sector focus on those things. The Internet of Things is actually interesting because we are also trying to figure out how that plays into some of the themes that are that have been near and dear to our hearts. We have companies across the board, chip companies, systems companies, as well as the internet part of the Internet of Things. There's been a lot of focus on the things part of Internet of Things, but we're also looking at the internet part of the Internet IoT space. Certainly all of those themes are very relevant to us, and we have companies at the early stage as well as companies that are quite mature at this point.
So I think from my perspective, there's never been a richer set of opportunities open to entrepreneurs than there is today. It's really quite breathtaking. I'd say just a couple of the big trends that we see at a high level. I mean, one is clearly mobile, which is just rippling through the economy. And it is just a pretty amazing thing that everyone today has a little mini computer in their pocket. And it enables you to do all sorts of interesting stuff. In the consumer world, as one example, it's led to this new personal economy where companies marshal huge numbers of people on an occasional basis to perform tasks, whether that's to drive you somewhere like Uber or deliver something like Instacart or DoorDash. In the enterprise world, I think it's still early, and enterprise tends to lag consumer a little bit, and the new apps are still kind of catching on as people move beyond just doing email and calendar, and the range of young companies in our portfolio, people like Clary and Kahuna, and then a massive infrastructure upgrade that comes with that, because now suddenly all the data and usage are on personal devices, talking about cloud applications as opposed to behind the corporate network. I'd say the second big trend that is just massive is the whole movement to SaaS and cloud. And I feel almost that we spent the last 40 years jamming technology into companies, and we're going to spend the next 10 years just ripping it all out again as everything moves in that direction. The final thing that I'd say that I think is really helpful to entrepreneurs is that in prior technology cycles, the large players have really been aligned. I mean, it's been the Intel and Microsoft with a chokehold. And the great thing about today is that the big players, Google, Facebook, Amazon, even across on the enterprise side too, the big players really do not get along, and that just creates all sorts of opportunities in the gaps and for different types of approaches. And I think it's a wonderful opportunity for entrepreneurs.
Yeah, so all the buzzwords that you named, big data, Internet of Things, wearables, cloud, SaaS, etc. I think all those areas, Intel investing or Intel Capital investing, have a very broad investment focus. But one thing to note is that I think we've been investing in those areas quite consistently before there were buzzwords, right? We were investing in business intelligence before it was called big data, right? But I think the opportunity we're seeing, specifically in my areas of focus, such as big data and business intelligence, is that the entire existing business intelligence industry, which is about a $30 billion stack of companies, mostly large companies like IBM and Oracle and others, that entire stack is getting rethought and redesigned and re-envisioned kind of to be able to handle the new types of data, new velocity of data, et cetera. And that's really the opportunity that I personally invest in. And we do it from infrastructure layer, we invest in Cloudera, Mongo, a number of other companies in the space, all the way up to vertical application layers where we think a lot of value is going to be with the business users and the guys who actually use that stuff. And so we're very interested in kind of the vertically business user focused applications taking advantage of a lot of that infrastructure that's being built.
So from our point of view, there's never been a time where there are so many market transitions at play across infrastructure. So I wouldn't say, be focused on one area, but I strongly believe that, 20 entrepreneurs with one unique insight can run circles around a 20,000 person company all day, every day. And what we look for is that one unique insight that they have over the big incumbent players. And part of that insight is not just on the technology side, but also on the market transition side. So for example, one insight could be something like, if in a world where all apps are moving to public clouds and more devices, more and more access to these apps is happening over mobile devices, the existing infrastructure guys cannot tie all these changes that are happening all over the place into one seamless experience for the end user. How do you can imagine a networking company that gets created that ties all these, makes sort of the modern enterprise app providers a seamless extension of the enterprise over mobile devices. That's a unique opportunity that people are still trying to figure out how to solve.
Adit, let's stay with you here for the next question, switching gears a little bit. Just as we sat through the last discussion in terms of working with angels and accelerators, et cetera, how do you see the role of the venture capitalist today? When should an entrepreneur look towards a VC fund versus some of the alternatives? And there seems to be, quite frankly, more alternatives than ever to fund your startup.
Yeah, so at the highest levels, one of the first reasons why you should consider venture capitalists is when you consider somebody to be a part of your team. So when you're looking for a true partner to help build a company with, whereas opposed to generic advice or a network to work with. So if you want someone specific to be on point. And the way I would test that out is, you give the venture capitalist some work to do and see what they deliver actually, and whether it's not just about connecting you to somebody, but actually giving them a work product to produce. And that's the way you judge whether you need if you get value out of it, you definitely want to work with a venture capitalist. That's my sort of highest point of view.
Just to add to that, I think there's a myth out there that it's cheaper to build companies now because of Amazon, and you don't need to buy your own servers and all that good stuff. Which is probably true. It's cheaper to start companies, but it's not cheaper to build companies. I don't know a single successful SaaS company that have not raised a huge amount of capital to be able to grow and build itself. And it's part of it has to do with the SaaS business model as it is, where you get the cash over time, you don't get the cash up front. So in the kind of historical traditional model. But it's just expensive to go acquire customers and scale. And so one thing while there's a time to get early stage angel money when you start figuring out what you want to build and in early stages of product definition, et cetera. But I think at the moment when you think you need to scale this, I think you have to go for institutional capital that able and willing to invest large amounts of capital over time into the company, simply because it is very expensive to build a large software companies.
Yeah, I'd say that the vast majorities of companies should not raise venture capital. I mean, it's pretty clear. And the reason for that is not good for the entrepreneur and it's not good for the investor. For a lot of companies, a great outcome is being able to build something up and then sell it for, $20 to $70 million. And there are a ton of acquisitions that happen in that range. And if you're an 80% of that company, that is fantastic for you as an entrepreneur and something you should absolutely do. The only reason to raise venture capital is if, as you get into your business, you think there's a bigger opportunity and the chance to get to, I'd say, at least 100 million in revenue. And if there's the opportunity to do that, then, as Igor was saying, while it's cheap to start a company, the two things that you need if you're going to build towards that bigger opportunity are expertise and capital. And on the expertise side, as an entrepreneur myself, when I started my company, I just found it really helpful to work with people who've seen the movie before, who can plug me into a network of people who really care. And seed investors, as we heard earlier, I mean, they have connections and all the rest of it, but they're hugely spread. And as several of them honestly said on the panel, they just don't have time to spend with companies. They will be nowhere to be seen as a company starts scaling, right? They're just not there. Whereas we invest in maybe a dozen early-stage companies a year, and we take a very active partnership with our entrepreneurs to support them and bring the resources of our entire partnership to help. It's just a completely different relationship. So I'd say that, again, for the small number of companies that fit into that latter category, I mean, it's not really a choice. You have to do it.
I think I agree with most of the stuff that's been said. I think where the delineation point is around what it takes to get to a significant milestone. I think that's one of the things Gene said on the previous panel, or a couple of people said on the panel. So it is true that you can probably get farther on $1 million today than you could 20 years ago. So that's a secular trend in the industry, which is generally good. I mean, it just means that if you can find $1 million and put it to work, you will probably accomplish a work product that's vastly better than what you could have done 20 years ago. But it's also true, what Aaref said is also true, right? If your goal is, you want to put in a little bit of capital, or you want to put in some sweat equity and then find an exit, because this is an idea where it's timely, it's tactical, it probably belongs as part of a whole product somewhere else, that could be a perfectly good strategy. I think where you want to look for venture capital and the growth that allows you is if you have a product vision or a market insight that can be really, really, really large. Or even to start up, there are some products, even today, if you want to do a chip company, people are still doing chip companies, and people are investing somewhat in chip companies. I think it takes a lot of capital to get to a product that is real and that's valuable in the market. So I think that's a really good delineation point, and you have to figure out you have to have that consistent view on what is the market you're targeting, what's the capital needed for the product you want to build, and what are the team's aspirations for where you want to go. And then find those partners who can support you. The second point, which was also touched upon here, is each of these funding rounds they are separate and they're milestone based for a reason, which is you want to make sure that the entrepreneurs and the company is achieving what they're setting out to do and they're tracking to those milestones. But life is messy. You don't always meet your milestones, or you sort of are getting there and it looks like it's positive, but you can't control the market. There are things that are within your control and things that are not. You do want to have partners who believe in you, who believe in the product vision, who have enough expertise in the market to see that this could work with a few tweaks, and who will back you when you need that backing, and who have the wherewithal to provide that backing. So I think that would be the other reason to go with a venture firm that can actually support you and make your idea better and sort of be patient with you if you need that patience from your investors.
So, Aaref, I think you talked about big ideas, the capacity for more capital and expertise. As entrepreneurs now come to raise a Series A, I think the last panel suggested maybe it was sort of $1 million threshold and up where you sort of bypass angels and you would maybe start thinking of funds. What would you advise entrepreneurs in terms of what is in today's market, sort of the right, typical amount for a Series A?
It's very hard to have blanket rules. I know it'd be nice if there were, but it's really situation specific. When we invested in WhatsApp in the Series A, there was no revenue or even a plan for revenue. Often enterprise companies, there are a couple of guys with an idea that we invest in, and that's basically it. So I don't think there are any hard thresholds. I think, as I said, if you have confidence that there's the larger market opportunity there, that it can support 100 million in revenue, and you're gung-ho about going for that larger outcome, then it's worth having a conversation or checking to see if it would be of interest to the venture capital community, because if you can get a venture capital partner, it's always better for your business because you have someone to work with you through the long term. So, I don't know.
I agree. I'm sure there's an average. If you take all the deals and you average them out, there's going to be an average Series A round, but I don't think it's an overly informative number. I think it really does depend on your particular business, which milestones you want to achieve, et cetera, et cetera. So I agree. I don't think there's a number. The only thing I would encourage you is to, the only worst thing that you can do is to kind of run out of Series A capital without really achieving, or kind of being on the way to achieve, but not quite achieving kind of the key milestones that you need to get to this next round of capital. So I would encourage you two things. First of all, give yourself, and there's going to be mistakes and errors along the way. Things are going to misfire. So you just, make sure you have some safety cushion to really figure this out and get to the next milestone before you run out of cash. And second is, every time you establish a valuation for your business, it always feels good when it's higher versus the lower, which I appreciate. But it also sets the promise and the precedent as to what you have to achieve to kind of move to the next milestone. And you just increase the risk of, not being able to meet that promise. If the valuation is very, very high, if you're able to raise on it, I guess you should, but that would be the one consideration I would have.
Anyone else on that? Okay. Well, Igor, as you've brought up the V word here with valuation, let's talk about that a little bit in terms of the market environment we're in today. Aaref mentioned WhatsApp. Congratulations, fantastic result. But obviously, we're in a environment where the exit market has been pretty strong, and valuations are pretty high. One might even say frothy. So, can you guys give us some insight on your views on, are we in a top of market era again? Is there a bubble happening? And how should an entrepreneur think about valuation as they go about fundraising, either in the earlier or later stages of their business? Igor, you want to kick us off?
When people tell me the company is worth $1 billion, and I ask them why $1 billion, and they said, you can't even buy 10% of WhatsApp for that. No, I just said what I just said, just in my earlier comment. I think, there's a desire to maximize valuation, as I think you always should. Just balance it out with the fact that, the Series A or Series B is just a milestone. It's not the ultimate valuation that you're after. And just don't overstretch yourself, where the milestones you would have to achieve to get a significant step up to that valuation become unachievable. And that just creates pain for everybody involved. So I think that's the only thing I would comment on.
Yeah, so if you take the sort of the one-offs outcomes that we've had recently at the highest levels, I don't believe that we are in a bubble. Most of the businesses that are being created today, or the companies that have reached 100 million revenue, are generally very good businesses. There are a few exceptions where where you spend a lot more on marketing and sales than on product revenue, and you kind of essentially buying that artificial growth. But for the most part, these are legitimate businesses. So, and then for the second part of the question around valuations, I think at the Series A or the Series B level, entrepreneurs shouldn't even care about those atrocious outcomes that are happening on the back end. For entrepreneurs, it's more about being able to partner with the right firm to work with, and as long as the deal is fair, I think they should continue working on building the company as opposed to worrying about valuation. So that's my 2 cents.
Yeah, I think there are several different ways to look at the valuation question, and we spend an enormous amount of time talking about it among the VCs. But I think, so a couple of markers on that. One is, there are companies being created right now that are swallowing entire industries. I mean, so we are in House, for example, which is a phenomenal company that's taking software to a very fragmented construction, redecoration, architecture type of industry. Sequoia is an investor as well. Those types of companies can be very large, right? They, if you get the model right, and you can actually change the workflow and improve the productivity of an entire, several billion-dollar industry, maybe a several $100 billion industry, you have the space to create a big company. And so you should command high valuations if you're able to show that you have an unfair advantage in those spaces. The other way is what Adit was mentioning. People will pay for growth. I mean, there are companies that are growing much faster than others. And so at the later stages, when it's obvious that companies have gained a market position as well as they've built a model where they can grow faster than their peer set, it does show in the valuation. But for the most part, if you're at the Series A and Series B stages, what you're looking for is to make sure that you get it. I advise my entrepreneurs to not get too worried about valuations and not to look for the one or two shiny objects that get the high valuations. You really want to focus on what's the capital needed for your company to build a good company there, and make sure you get a fair market view, but don't get too hung up on the specific number, because you do have a long journey ahead, as Igor was saying.
I don't know. I mean, I say bubble schmubble, it doesn't make any difference. There is a massive secular shift towards technology, and that will power the industry for the next couple of decades. And then around that, you have these cyclical gyrations. Anyone who's too concerned about cyclical gyrations shouldn't be an entrepreneur, because you're thinking too short term. So I would ignore all this nonsense and just focus on building your business. And in terms of the valuations that you're likely to get from venture capital firms, I mean, let me tell you, having been in this business a while now, it's pretty hard finding something that you really want to partner with and that you really think is a great business. When you find that business, the last thing you do is try and pull a fast one and offer someone some ridiculous valuation below market. So, and if a person tries that, then they're clearly not the type of person that you want to be in business with. So any good venture firm will put forward what they believe is a very fair valuation. And if you're talking to a couple of different people, you'll have a good sense for the market, and you'll be able to make your own decision.
Okay, I think we have time for one last question here. So we haven't really talked too much about sort of Series B and beyond. And Rohini, we had chatting earlier about this dynamic where for some firms, Series B can be challenging. On the other hand, you're reading about some really kind of supersized Series B happening. What are your views on follow-on funding at this stage?
Yeah, no, I think we were chatting about sort of I guess there's a Series A crunch in some parts of the market, and people have talked about that. I think the Series Bs are actually quite tricky for companies, because the Series B tends to be the one where it's hardest to read, right? You may have built a product and you may have taken it to the market, and there's some proof points that it's working, but you don't yet have an established business model, right? And it's very hard to read whether this actually goes up into the right from there or not. So some of the companies where they have been good at getting out the door and they actually get ahead of the market proof points, and we saw some of the strong funding rounds that have come out, like we saw Thousand Eyes, for example, which is an excellent company, and they have been able to show proof points ahead of where you would expect them to be at Series B. They have very, very strong valuations and so on. But sometimes you come out, you think this should work, and they're just a little bit behind, and the Series B tends to be the one where you say, okay, this looks like a Series A plus. They don't have all of the market validation you might like, and venture firms tend to be most cautious about that. So you have what tends to happen is, if you look at it as a portfolio, you'll have a few Series Bs that are, there's sort of this idea of a flight to quality, where the few Series Bs where the market proofs are there get all of the attention and people are chasing after those deals. And there will be a number of them where people are saying, you know what, maybe I'll wait this out and wait for the Series C when things are done. So that was what we were talking about, and others might have comments on that stage.
Yeah, no, I think Rohini makes a very good point. I'd say from a valuation perspective, there's a greater variance in Series B. I mean, you've got a range of 20 to 200. It's just massive. And it's not that people are trying to do anything. It's just that people genuinely don't know exactly where they should be valuing the company. From an entrepreneur's perspective, the one thing that I would do is, as soon as you've raised Series A, I would sit down with your investor and talk about what milestones are we going to hit for Series B, and then I'd ask myself who's potentially would be interested in the company at that stage, and I'd work from right then to build a relationship with those people so that when you come to the Series B stage, they're familiar, they've seen you hit your goals and your milestones, and I think that really gives people confidence in coming forward for the next round.
You know, I don't know if there is a Series B crunch per se. Series Bs tend to be probably, while we do invest across stages, I think Series B is probably our most frequent series where Retail Capital invest. And I haven't seen any companies who are foundable and doing well having issues raising money at Series B, either from us or from somebody else. So I don't think there's a Series B crunch per se, that there's no capital available. I think the valuations are all over the place. I agree. I guess the only thing I would add on Series B, as you're thinking about not just the valuation, but who the investor should be, is think about diversifying your investor base. Kind of no different than you would think about diversifying your management team and ensuring there's different skill sets present on your management team. I think the same thing applies on your investors, right? So if you have two high-quality financial VCs who did your Series A, I'm not sure that the third high-quality financial VC that you would attract in Series B would bring a whole lot of incremental value that the other two firms would not. So I would look for people who can help with go-to-market, et cetera, and that's kind of what we pride ourselves on. But I would really think about diversifying the skill set that your investor and the value that your investor can bring to you as you are beyond. Like I said, third high-quality financial investor is not going to bring a whole lot of incremental value besides the two you already have from your Series A.
You know, as someone as a former entrepreneur, I would say, you know, after my Series A, my Series B was a big down round, and it was tough for all of us in the company, and I had literally pretty much, you know, my ownership stake went down, and so the lesson from there was raising a Series A at a very high valuation and not achieving those milestones caused that down round in the Series B. And same could apply to the Series B as well. I've seen a lot of companies raise very high price Series Bs and then not achieving those milestones, and the Series C looks very tough. That's happening in the marketplace today, believe it or not.
Great. Well, with that, great insights, everyone. And please join me in thanking our terrific panelists today.